Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of April 7th. I want to thank you for joining us. I also want to remind you, don't forget to like and subscribe below if you find this content helpful and informative. Also, take a few minutes to check out some of the other content we post. So as usual, my goal for these videos is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. As always, we'll start by looking back at last week. And of course, the biggest headline of last week is tariffs. So quote unquote, Liberation Day occurred. President Trump announced the new reciprocal tariffs on the majority of countries and all of the US's major trading partners. And despite all the discussion and all the lead up, the size and the scope of the tariffs still caught nearly everybody off guard. They were significantly larger than most had anticipated. And with that in mind, we unfortunately saw the stock market react in a negative way with the biggest two-day sell-off since COVID. The bond market jumped with bond yields dropping and prices rising. The value of the dollar fell pretty significantly, and the volatility index, known as the VIX, took off to recent record highs. Assuming that the tariff rates proposed last week actually do go into effect as written and reported, we would see the average tariff rate for countries in the United States increased by the largest amount since the Great Depression. The average tariff rate would rise from about 2.5% per country to about 22.5% on average. We also saw a 10% baseline tariff across all countries, and about 60 other countries who saw additional higher tariffs. Specifically, we saw an additional 34% tariff on China and an additional 20% tariff on the European Union. As is the case at the beginning of most global trade wars, we saw immediate talk of retaliation amongst a variety of countries. We saw immediate retaliatory action taken by Canada and China, and we saw near-term plans from the European Union to implement retaliatory tariffs. We also saw French President Emmanuel Macron suggest that European investment in the U.S. should be suspended, and we've seen rumors and ongoing discussions that there are government officials from tariffed nations reaching out trying to negotiate reduced or delayed tariff rates, although we have not seen any confirmation from the White House or the administration that any of these changes have been seriously considered. Last of all, on tariffs, before we move on to the job market, many economists are suggesting that these increased and significant protectionist measures by the United States will serve to alienate trade partners, and one of the nations who will most likely benefit from this new protectionist regime is China. The number 2 economy in the world has the potential and the desire to pick up some of the trade relationships which may have been discarded or may have been bruised by these additional protectionist measures. Switching our focus over to the job market, we saw the jobs data for the month of February and March reported last week. We saw the job openings and labor turnover survey demonstrated that the number of job openings in February dropped by about 200,000 jobs, but this was actually significantly less than expected. We also saw the national data and the ADP private employment data last week. Unfortunately, the unemployment rate increased for the second straight month from 4.1 to 4.2%. But the private job growth and the national job reports both exceeded expectations, with the national report indicating 228,000 jobs were added in the month of March. As far as the unemployment insurance program, we've actually seen the number of new initial claims for unemployment insurance holding steady for the last few weeks. In spite of this steady level of new claims, we're unfortunately seeing a more difficult environment for folks with continuing claims, as the continuing unemployment insurance claims reached the highest level they've been since November of 2021. We're also seeing individuals working part-time for either economic or non-economic reasons are both still significantly elevated. And most analysts suggest that this job report for the month of March may in fact have been the last not-so-bad report that we may see for a little while, as the lagging effects in the economy and the potential for economic slowdown may start to catch up with the job reports in subsequent months. Switching our focus to the economic data we saw last week, unfortunately, we saw more stagnation in the manufacturing and service sectors. Unfortunately, as far as manufacturing is concerned, we're seeing new orders starting to fall. We're seeing the level of overall factory orders stagnating with very little growth. And we're also seeing input prices growing significantly faster than expected. And unfortunately, in the service sector, we're seeing significant concerns about tariffs, about hiring, and about capital expenditure, as the potential for an economic slowdown or even recession in 2025 seems to continue to grow. Now, switching our attention to the stock market, unfortunately, following the announcement of the Trump administration's higher-than-expected tariff policy, we saw the stock market take a significant hit. In fact, the Dow Jones Industrial Average was down about 8% for the week. The S&P 500 was down about 9% for the week. And the NASDAQ officially entered bear market, meaning a correction of 20% or more status, with a drop of approximately 10% last week alone. We also saw the volatility index, known as the VIX, which demonstrates the level of fear and concern in the market, jumping from an elevated level in the 20s to a very concerning fear-oriented level in the 40s throughout the week. In line with the significant pullback in equities, we also saw a significant increase in demand for fixed income assets, specifically safe, risk-off assets like treasuries. The demand for 10-year treasuries skyrocketed, and the yield on the 10-year treasury dropped precipitously to a point below 4%. We also saw Bitcoin rise and fall a little bit, but ultimately end the week about where it started, around $84,000. We saw the market for crude oil absolutely take a dive, in part because of concern over the tariffs and now a global economic slowdown, but also in part because OPEC Plus, the Organization of Petroleum Exporting Countries, announced that they would increase production, potentially flooding supply and pushing prices down. We saw the price of gold rise and then fall, ultimately throughout the week, losing about 1%, as a lot of the safe haven attention had shifted to treasuries. And we saw the value of the dollar fall significantly as concern for a U.S. recession, possibly the potential to lead into a global recession, started to take hold and become more tangible in light of the new tariff policy. So with that, let's take a look at what we can expect this week. So first of all, Q1 2025 ended at the end of March, and so we jumped straight into earnings reporting season for Q1 of 2025. And as with every earnings season, we typically start with the financial sector. On Friday this week, we'll actually see JP Morgan Chase, Wells Fargo, Morgan Stanley, and BlackRock all reporting earnings for the first 3 months of the year. Focusing on the economic data, we'll see reports this week on consumer credit, wholesale inventories, the Treasury budget as far as the federal government's expenditures. We'll also see information from the NFIB Small Business Optimism Survey. And we'll see preliminary data for the April Consumer Sentiment Report. Now, these consumer sentiment reports have been worse and worse and worse, deepening concerns and uncertainty each month for the last 3 months. So the big question is whether this report will continue to fall or whether at some point we'll actually see a bottoming out of these sentiments and concerns. Also this week, around the middle of the week, we'll see the updated reports on the Consumer Price Index and the Producer Price Index. All eyes will be on these gauges of inflation, especially in light of recent tariff announcements. Throughout a lot of the soft data, we've seen growing concerns about higher and quickly rising input costs. So the big question looking through the CPI and the PPI data will be, have these increased input costs for producers and manufacturers transferred through to the consumers in the form of higher consumer prices? This leads us to our look further into the future. For the last couple months, there's been significant weakening in the soft data, considering consumer sentiment, consumer confidence, the survey data that we see coming out of industry and manufacturers. But as I've mentioned before, the big question is whether this sour sentiment, this fear and uncertainty, ultimately translates into changes in economic behavior and expenditure, both among consumers and businesses. And until we see this crossover, we most likely won't see significant action taken by the Federal Reserve, either to address inflation or to address unemployment or a slowing economic market. The soft data is an excellent perspective, an opportunity to see how the economy is feeling. But until it translates into the hard data, it's typically not enough justification for significant policy changes. So if you're looking for interest rate cuts, we most likely won't see cuts or increases until the hard data starts to reflect a need for either one of those. These are certainly unprecedented times, and the fear and uncertainty being reflected in surveys and in general consumer and business sentiment is not unusual and is not surprising, given the constant changing environment and unpredictable nature of the future. One thing that can be incredibly beneficial, both for mental health in terms of uncertainty and fear, and for financial preparation for the future, is focusing on preparing for potential emergencies, establishing or increasing emergency funds, focusing on saving money and preparing for potential unexpected events in the future, allows individuals and companies to find themselves in a much better position to weather whatever changes the future may hold. One of the other things I would strongly encourage folks to do is to be just a little bit more informed, read just a little bit more about what's happening, and of course, not only to self-promote, but check out these videos we do on a weekly basis. We really do put in as much time and effort as we can to read through every economic report, every change in the market, the analysts' opinions, and bring you the information that we think would be the most helpful and the most beneficial to understand. With this information, with our reports, we do our absolute best to help make sure everybody is up to speed on the markets. But that doesn't mean that this video is the only source of information. Hopefully, you supplement this video with other forms of information, including some of the other great videos here on John G. Ullman's page. And with that said, keep in mind you can always bring questions to the comments, and we will do our best to answer those questions in our videos each week to the best of our ability. So with that said, try to keep your head up, stay informed, prepare for potential emergencies, and we'll see you in next week's video.